we'll see in a minute, is the so-called market sizing. Market sizing is basically the practice of evaluating the potential value of a market. Basically, it's a classical practice, probably if some of you come from marketing or business management or corporate management. Okay, continue without. So far, I can discuss without the slide. You know, market sizing is that procedure that you, as a company, you do before launching a product. Okay, you want to launch, for example, a new smartphone, a new car, a new laptop, a new IT gadget, a new app, whatever, a product. Before that, there are a lot of analysts that try to understand what is the size of my market. And first, and which percentage of this market I can get. So this approach, market sizing, is good if, let's say, for the long term. So in perspective, where the price of my product, in this case Bitcoin, can go. So it's, let's say, it's for the long term. Of course, it's not, let's say, good for the very short term. For that we'll see a second approach, which is slightly different. But for the long term, market sizing is really give you an idea, an approximate idea of where we can go with that product. Okay. So basically, in case I'll present now an analysis, I think this is the most complete, about the market size of Bitcoin that was made by Bank of America in 2013. That basically considered that Bitcoin should be evaluated with regard to two functions. That is, one function is the medium of exchange. So I use Bitcoin to exchange goods. So we have to value this medium of exchange. This is the first main part of the value of Bitcoin. The second part of the value of Bitcoin is the so-called store of value. Store of value. Самый большой пример – золото. Okay. I take my gold, I buy gold for the bad times as a store of values. Okay. And this is the second part which I had to evaluate in order to find the possible global value of Bitcoin. Okay, let's start for medium of exchange. How we can value the medium of exchange? Let's say Bank of America make quite a reasonable choice. They consider that as a medium of exchange you can have two possibilities, e-commerce or money transfer. So let's start from e-commerce. Here I put in formula what they describe it, so it's much more common. This is actually their assumption, but it's quite reasonable. Now I describe this formula that they used to find out the value of the e-commerce for Bitcoin at time t. So what they do, they take the consumption of in the US for the last 10 years, standardized by the household deposits in the US for the last 10 years. So consumption over deposits, average over the last 10 years. Time, the amount of the business to consumer in the last year, okay. The amount of the business to consumer in the last year. Time, the Bitcoin share, so how much of the business to consumer will be in the future, I told you it's the long term, it's not tomorrow, will be dealt with Bitcoin. They use a kind of range between 5 and 50%, usually around 10%. Okay. All this multiplied by the ratio of the world GDP, the VP mirror, against the GDP of the US. Okay. in 2013, this was around 5, this ratio. So the GDP of world is approximately 5 times GDP of West. So using the data up to 2013 and 10 years before, they find out that approximately the potential value for the e-commerce should be around 5 billion. This is one part. Second part of the medium of exchange is money transfer. For money transfer, actually, there is quite simple, I would say, but robust approach. What they do, they simply consider the average market capitalization of the 3 biggest money transfer players around worldwide, which are Western Union, ידעו מפסיד znают, MoneyGram Euronet. MoneyGram это более США, Western Union это более европейский. No, it's the biggest one. If we do this average with the latest capitalization, actually we did in 2013, we get approximately at that time 4.5 billion. Okay, this is for, so these two components, around 10 billion, are for the medium of exchange. Clear? The other component that Wu and the other co-authors, actually it's quite a big group, around 6-7 people, that this component they try to evaluate is to store of value. Basically, they try different approaches because they tried first with gold, then they with silver, and actually they found out that actually the closest approach is to consider the value because as a store of value, basically very close to the total amount of silver eagles. Silver eagles are kind of quite standard, are the most important silver coin in the US. Это как в России это Георгий Победоносец, думаю, да, сами известный. В US is the silver eagle for silver, and of course the gold eagle for the one. So it's the most classical, actually it's the most sold coin because in the US. And actually they found that basically they do several computers. They found that actually the closest formula, the most available, is taking 60% of the total amount of silver eagle minted since the 1986, the first year they were minted. Since then, basically, around 12,000 tons of silver were minted. So basically, they found this simple approach, and also in this case, we're around approximately 5 billion for the store of value. So in the end, how we can find the price in the long term? The value for the e-commerce, 5 billion. The value of the money transfer, 4.5 billion. The value for the store of value, 5 million, divided by the total amount of Bitcoin in circulation. If you do this, you get approximately $1,300 for one Bitcoin. So I told you this is in perspective. There are two smaller approaches because this actually was kind of well analyzed, is the largest one. This is why I reported in detail. There are other two approaches, but unfortunately are not published, are kind of working papers, are only reported here for curiosity because are not peer reviewed, are not checked, so it can be a little bit. This year, Mark basically valued the Bitcoin like a high-tech Nasdaq startup, basically. And basically suppose that the Bitcoin will substitute a percentage of all the money transferred, consider dollar, euro, Japan yen, British pound, and so on. And basically supposing that it take some percentage, I think 10%, it get around 50 euro. Even though the assumptions are really a little bit too strong. So I report for curiosity, just for you to know, but I'm not that interested in that approach. Another one by Houtinen, this actually is quite interesting. Actually, this is a master thesis, this is why I only report on a couple of words, but actually it's quite well made. Basically, again, the approach in this case is basically to consider all the global aggregate of M2. M2, as you know, is banknotes plus short-term government bonds. Okay, so take M2 for US dollars, euro, and Japanese yen, and basically making some assumption which percentage of this amount will be substituted by Bitcoin. So, of course, depending on the assumption, you have different value of the Bitcoin. So you take the percentage substitute and you divide by the total amount in circulation. He said, even though it's not clear why, that probably for him the most reasonable percentage would be 0.1%. So in this case, the value of Bitcoin in the long term should be approximately 1,500 euro. Okay. So these actual minor approaches are reported for curiosity, while the work by Bank of America is probably the more detailed that I found and is quite reliable. So this is, I told you, market sizing, I told you, is kind of an approach that you do at the beginning to understand the value in the long term of a product. In our case, Bitcoin. Of course, as you may imagine, this is not good if you want to understand the short-term value, the short-term dynamics of Bitcoin. Clearly, it's not satisfactory, and it's not actually the goal. You know, market size is for the long term; it's not for short-term or medium. An approach that really in the last year particularly had a lot of success, actually because it really is what the miners really do, is to basically to compute the so-called marginal cost of Bitcoin production based on electricity consumption. The very first that proposed this approach is Garcia, in a beautiful paper published on, it's an IT journal, I don't remember the name, in 2014. It's an IT journal of the Royal Society of the UK Royal Statistical Society, I don't remember the name at the moment, where basically he said that the miners look at the cost of mining, and the major input of cost of mining is the electricity consumption. And basically he computed very roughly at that time kind of a lower bound using really the cost of electricity, the amount of time, the amount of megawatt use, and so on. Instead, what I want to present here is probably the most detailed work of the marginal cost proposed by IS. Actually, IS was a very, very nice guy because he just published in the paper is the 2015B. Imagine, I wrote this paper, I finished writing this paper in January, okay, translated in May, but I finished writing this paper in January 2015, and at the time this was still a working paper. When I put the paper accepted by Preclad Econometrica online, I just read my paper and basically just called me, look, I just published this paper in Informatics and Telematics, which is one of the top IT journal. Please, I'll let you. Yes, I will tell the editor to change, so he's a very nice guy. Also, he wanted to send me other papers. I said, look, I'm very busy at the moment. He wanted to have feedback from other papers. He's a very nice guy. He's in New York University. So actually, if you want, you can contact him because he's a very gentle guy. That really, and he's the one that has proposed the most detailed approach that we will discuss now in full details. Because it really goes into the Bitcoin operation. So what are the main variables in this approach that we'll discuss in details? So we have 5 ingredients. Okay. We have the cost of electricity, usually cents for kilowatt hour. The energy consumption per unit of mining effort. You can define, actually this is not only I, also in Garcia, as gigahash per second, or using the transformation in watts per second in joule per gigahash. So watt per gigahash per second or joule per gigahash per second. So depending on the transformation, which kind of variable you want to use. Got the Bitcoin market price, the difficulty of the Bitcoin algorithm, and the block reward. Here it's written currently 25. Because when I wrote the paper, it was January. It was January. Of course, in July, the reward has been halved in 12.5 Bitcoin. And actually, this is one of the main reasons why the price increased. But then we'll come in a minute about that. So let's keep for the second 25, but then we'll come back. So these are the main ingredients of our algorithm, of our cost algorithm. So let's a little bit more into detail. Basically, that is quite simple in itself, in the sense that basically in an efficient market, you know, the marginal cost and the marginal profit should be basically equal. And basically, if my marginal cost is higher than my marginal profit, basically I should stop producing. So how can I compute the marginal profit? Well, for doing that, similarly, I is compute the so-called expected number of Bitcoin daily per day. How? Here is the formula. We'll comment step by step. So, number of Bitcoin, this remember is the number of expected Bitcoin per day, not real, expected. Beta is the block reward, 25, today 12.5, but let's keep 25 for the moment. 25 per block. Rho is the hashing power of the miner. Okay. This of course depends on the single miner. We will use an assumption later for about how much, but this really depends on the single miner. Divided by the difficulty of the Bitcoin, the current difficulty, time 2 to the power of 32. This is the standardized probability that a single hash solve a block according to the SHA-226 algorithm. So it's the probability to solve the block. So number of seconds in an hour. How many seconds we have in an hour? 3,600. Number of hour in a day, 24. So I repeat. So the expected number of Bitcoin expected in a day is block reward time hashing power employed by the miner divided the difficulty. The standardized probability of a single hash of solving a block. This is by construction the probability of in the SHA-256 algorithm. All this multiplied by number of seconds in an hour multiplied by the hours in a day. Okay. So here just what I told you. So to understand it, I told this normalized standardized probability of a single hash per second solving a block. Okay, it's a property of the SHA-2056 algorithm. Of course, if you use a different algorithm, it's a little bit different. For example, as I told yesterday, and probably Sergey can tell you more, there are several algorithms, cryptocurrency that use alternative method, because for example they use the script algorithm, which is much better, much stronger than the SHA-256. I think the IT expert can tell you much more than me about that, so I don't add this. So I just stick to the SHA-256. Of course, probably you can write a paper with a different algorithm, so the formula is slightly different, but more or less I think it's the same. Oh, so the number, expected number of Bitcoin today can be written in a much more compact formula by putting together all the constants. This is a classic. So what can we put together? We can put together the number of hours in a day times the number of seconds in hours divided to the 2 to the exponent 32. So we get this fraction. We call, for simplicity, this theta. So we put all the constant together in theta. Okay? So this is our only constant. Reward, hashing power, difficulty. Okay? In the original paper, and actually in the other similar paper, they use as hashing power 1000 giga hash per second. I think it's quite a realistic assumption. Maybe it may change over time. We'll keep it for now. Probably Sergey or more probably IT expert can tell you much more if it's not reliable. But I keep the original assumption of this paper. I asked Sergey, is it realistic an hashing power of 1000 gigahash or is it already passed? What do you think?
Which one?
This one. The hashing power of the miner.
It depends on the miner.
On the miner, so it can be
sample mining unit can be like it. But
can be an average. Can be good as an average such a number.
Like an average device.
Yeah. So this is actually the value given by us. So let's continue. This is for the profit. Let's go for the mining, or the cost of mining. The cost of mining, again, the formula proposed by us is very, very simple and more reliable. Actually, this formula is implemented, for example, in many websites. For example, if you look on the web, there are a lot of websites, really. I was surprised by how many websites with some differences, but more or less the idea is the same. Basically, I have kind of built-in routine in this website that show you how much profit and much cost you will have for mining. There are a lot of websites that do that. Basically, you input the hashing powers, the electricity cost. There are a lot of websites. I was surprised how many there are there. That give you the possible cost. And more or less, the formula is similar to this one. So, price per kilowatt hour times 24 hours a day. The energy efficiency, this depends on the miner. Watt per gigahash per second, this depends on the miner. Hashing power and divide by the standardization of 1000 gigahash. If, and this is the key point, but I think now is satisfied. The key point is here. We suppose that we are an efficient market. So in efficient market, we have marginal cost equal to marginal profit. Okay. Then the two equations should be equal. The cost and the profit should be equal, and from this I can take out the price. Okay, so the price actually should be given by the ratio of the expected number of Bitcoin. Expected cost by day divided expected number of Bitcoin per day. This is all only in efficient market, because only in efficient market the marginal cost is equal to the marginal profit. I agree with Dias that while this is true now, in the early days of Bitcoin this was not true. In the first 2 years, like 2009, 2000, probably up to 2011, this was not true because in the first years of Bitcoin, clearly the Bitcoin was not an efficient market. Because really imagine the Bitcoin was mined.
I beg your pardon. Is this assumption is right now because the majority of hashing power is distributed not equally, so it's not a competitive market.
Yeah, actually, good point. I'm coming in and say thanks for the comment. A good observation. I'll come in a second. So at the beginning, I told you it was a really kind of very amateur, let's say, mining. It was sufficient also a laptop to mine Bitcoin. Well, nowadays you really need a full room with specialized hardware to be profitable at the least. I think the last year were extremely efficient, but now, as your colleague correctly says, basically we have the majority, for example, also as Sergey just told yesterday, the majority of miners that, for example, now are Chinese. A couple of months ago, one of the biggest Western mining group basically went default. So actually this does not surprise me. Because in all the system, all economic system, the natural tendency is to go to oligarchy.
Yeah.
To go to an
oligopoly.
oligopoly market. This is natural tendency in all markets, not only for Bitcoin. To go to a concentration of capital or groups, and the same is happening. At the moment, it's more or less efficient. How this will impact in the future, of course, remain to be seen. Of course, if we are in an oligopolistic market, of course, we have a less efficiency and higher prices. But really, this is really, I think, it's quite early because at the moment the Chinese so far are not interfering too much, let's say. But of course, in the future they can interfere. Also because, as I told you probably yesterday or to some colleague, some of your colleagues, if you are controlling the supply, because now the majority of miners are Chinese. And if you control most of the demand, because most of the demand for Bitcoin is Chinese, basically you control the market, as you understand. Personally, and but this is my opinion, of course I don't write here because it's clearly too early, but only my opinion by uniting the dots, if I can say so, is that basically the China is trying basically to make Bitcoin a kind of digital one or 1-2, okay, and actually it's quite intelligent plan and program because basically, in China a lot of people, particularly the poor people, in China there are very strict capital control, very very strict. Many people fear that the yuan will devaluate. For example, now it's slowly devaluating the yuan. So many people are buying Bitcoin. But if Bitcoin is basically more or less controlled by Chinese authority, you remain in the same family. So you go from the paper one to the digital one. Remain the same.
By the way, I think in your model you also must keep in mind in your model you must keep in mind the following issue, that there were so-called early miners, insiders of Bitcoin protocol, who mined first coins for free.
Yeah.
So there is third part of all Bitcoins concentrated in some hands which are known. And those guys are not Chinese. They are not miners. They are early miners who just started to mine Bitcoins when it was for free. So they are market makers for this. So not only Chinese are market makers for Bitcoin.
They keep still. Of course, if they sell the Bitcoin, they can influence the price. But remember, in the end, what actually, if you control supply, you also.
For example, such guy is Roger Ver, No.
No, that's true. Of course, the early miners can really influence, at least temporarily, the price, because if they start selling all this Bitcoin that they have, of course, the price would collapse. Anyway, if you control the supply, in some part, you can really control also the remaining of the market. But that in this, actually, we enter about monetary economics, so it's kind of a different field. Okay, coming back. So. Suppose actually for the miner I think it's quite realistic to have an efficient market, the price basically given by expected cost divided by expected number of Bitcoin per day. Let's make a simple example. By the way, the Excel file of this example is on my website, and also I'll give you, of course you can use much efficient software, but just to give you an idea. So suppose an average electricity cost of 13.5 cents, which is actually the world average in 2014 and 15. So what do we have? So supposing we have 1,000 gigahash mining rig. So we have the price per kilowatt hour, we have 13 cents. 24 hours a day. We suppose an energy efficiency of 0.75 watt per gigahash per second. That more or less is what we have now. Probably the best are much lower, but on average, I think we are now there. We have, suppose, a mining ring of 1,000 gigahash. So 1,000, that's simplified. So the expected cost per day is approximately $2.43 per day. This is expected cost. Number of Bitcoin per day, of course, my constant, where we have all the constant, it's no change, it is second, hour, standardized probability of a single hash to solve a block. Block reward 25. You remember I did this in December, January 2000. In January 2016, December 2015. Raw, which is of course is 1 gigahash, so 1 to the exponent 12, divided by the difficulty. The difficulty in January 2016 was around 60 billion or something. So this is the difficulty in January 2016. If you get this, the expected number of Bitcoin per day is 0.00 number of Bitcoin per day.
Sorry, and
Yes.
may I ask you about one assumption? Where did you get the number 13.5 cents per kilowatt?
This one.
No, first one. 13.5 cents
Yes.
per kilowatt
This
world
is,
average
is
electricity.
the average worldwide
And where do you
average
get this?
cost
Where do-
from AIA, Energy Information Agency from the US. They provide several average electricity cost for all one. I think you can. AIA is for free. If you have access to the IEA, International Energy Agency, actually unfortunately is for payment. You can have a little bit more detail, but I think this can be already. AIA, Energy Information Agency. It's
It
the
looks,
US
like, it
department.
looks like for your paper, for mining purposes, you must find out another rate.
Yeah, of course. you
Because
have to use
average
the
rate for
local
the
rate.
world,
No.
because
This-
many countries are not engaged in this
Yeah,
business
of
at all.
course, of
For
course.
example, as Norway, because there are higher prices. And on the other hand, Saudi Arabia, where prices are very low, they are also not making this business.
Yeah,
Or Sudan, where the cost of electricity
I
is
know,
one,
no. This
one
is of
cent.
course is
Yes?
the worldwide average because it's kind of an idea
So
to get.
it's a
of
wrong
course,
number.
I think if you, for example, if you are a trader, probably you have to, of course, to adjust this. If
It
you are a
must be
trader in
adjusted,
China,
yes.
you have to take the average price in China, and so on. So this is kind of general for can be easily modified for where you are. Of course, you have to use the energy efficiency of your mining group. Here, I use the average.
Because it looks like an average temperature in a hospital.
Yeah,
It's
yeah,
always
so-
average normal, but some people
course,
are
of course.
already dead.
This is really just a framework. Then you have to adapt it on your mining rig and so on. We're almost there. So we take all the ingredients of our pizza. So we are ready to bake the pizza. So the price is expected cost divided Bitcoin per day. So 2.43 divided expected number of Bitcoin. So we have 200, approximately 300 Bitcoin dollars per Bitcoin. This is the cost that I had when I did this in December, January. In December 2015, January. Remember, I finished writing that paper. I submit more or less at the time. The interesting is that if I wrote this in January, if we halve the reward to 12.5, because already in December last year, nieuwsjournalist of Yule, the reward would be halved, would be cut by 2. I said in the paper, if we halve the reward to half, by using this simple approach, we will see that the price should at least increase to approximately, it should double. And in fact, actually what happened, because the price that was at the end of 2015 was around 300, approximately at that time. Increase, now we are 600, and now we are 650 because also there are pressure from Chinese buyers because there is the one that is devaluating quite a lot because China want to decrease the loss of forex reserves, so one is a little bit devaluating, so there is quite a pressure of Chinese buyers. So now the price is, the last price 650, 660, I don't remember, but we're not far from this. So this to show you how this quite simple approach can give you really, as I defined the paper, a lower
Great result, it works. And have you bought bitcoins that time?
No,
You wrote the paper.
unfortunately, no. Unfortunately, no, because
So
really,
theory and practice are the same. In practice, they are not,
yeah,
right?
Yeah.
You must buy.
Yeah, I know. I should have both. Really, it's no. I want to thank you actually, Sergey, for involving me in this project because for me it was very interesting. Actually, now I know more. Actually, it was a way for me to learn myself. Research is also a way to learn. At that time, now I know a little bit, so I feel more secure. At that time we're just.
Are you going to purchase now?
Well, I think I may put. I'm waiting to see what will happen to Italian banks and to Deutsche Bank. If
Deutsche Bank will
Deutsche
run
Bank, because
it is bankrupt.
I don't know which is worse between the Italian banking system and the Deutsche Bank. No, actually, in Germany there is a big problem that they keep it very silent. Probably no one of you knows, or probably someone. I don't know if you ever heard about the Landesbank. Probably okay, you know it because you work in the central bank, so you know. The Landesbank are kind of small popular bank, like saving banks. It's kind of in the West, particularly in Italy and Germany, there was there was a very old tradition, this kind of small saving banks, local banks. And imagine in Germany, this Landesbank,
Земельный банk.
Landesbank, are outside the supervisory control of the European Central Bank. They're outside. In fact, the German pushed for them to be outside. Why? Because in this saving bank there is a lot of dirt, a lot of bad loans. Really, I know that the Italian-German efficient up to a point. Because also this bank were kind of local, where friends of friends give loan to the friends with very, very high number of bad loans. And the Germans want to keep it local because if why the Germans are very nasty with the Italian banks, they say, you have to check. With the Landesbank, they're very, very strict. They don't want that we look inside, that the Europeans look inside, because there are a lot of bad loans. What is the problem? That and this is why, for example, now the Germans are quite quiet against the Italian banks at the moment, because if the Italian banking system go down, also the Landesbank and Deutsche Bank would go down. The Landesbank, because they have a huge number of loans, and most of these loans are to local company that have as subcontractors Italian subcontractors. So they were a very big problem. Deutsche Bank would also go under because Deutsche Bank has a huge exposition in derivatives. So in case of a collapse,
It's run out of capital.
yeah, of course, it would run out of
Also,
because,
it's the greatest laundering machine in Europe.
yeah, it's because it's a huge exposure on derivative. In case of a market collapse, of course, all the derivatives would wipe out all the capital. So really, it's kind of unstable equilibrium. It's a terror equilibrium, let's say. So the Germans say, okay, we don't disturb you so much with the Italian banks, but you don't look to our Landesbank. So we'll see. Actually, it's a very unstable situation. So in that case, I may consider also a small investment because I think to manage the savings. I'm not a daily trader. I only manage the savings of my family. I buy 2-3 times a year. I'm not a day trader. Okay. So this is for the value of Bitcoin. So we saw a long-term approach and a short-term approach. So the long-term can be represented as an upper bound. Market sizing is an upper bound. What we saw, the marginal cost of Bitcoin based on electricity consumption can be represented kind of a lower bound, okay, where the price should go, because below that level is not profitable to mine. Between these two levels, of course, the price move. The question is how we can model these dynamics. So how can we model this day-by-day dynamics? Because I told you, these two approaches are good as bounds. One for the short-term bounds, the other for the long-term bound. But still, we don't know the dynamics, the daily dynamics. So to model these dynamics, there are several approaches. How much time we have before the break? So I represent myself.
Like 40 minutes.
40 minutes. Okay. So I'll show you the main approaches, econometric approaches about it. Okay, a simple approach that I won't propose because I know that here there are a lot of people involved with several cryptocurrencies, not only with Bitcoin. This is what I propose here. This is quite simple, a simple analysis cross-section proposed by IS in this third publication, published also last year. This is simple cross-section regression where basically it takes all the 66, a group of 66 traded digital currency, Litecoin, Bitcoin, Ethereum, Ripple, and so on, taken in a single day, September 18, in a single day. So it's a cross-section, it's not a nie analiza vremenink rядов, это только regression. So if it's regression on a single day, it's a picture, yeah. Where basically these prices of all these crypto, all expressed in bitcoins, all the price of this cryptocurrency expressed in bitcoins, okay? So there is no dollars here. So we are in the digital monetary system, let's say. And these prices are regressed against these 5 variables. Which variable? We have the logarithm of the computational power in gigahash for that cryptocurrency, the logarithm of the number of altcoin found per minute, okay, the percentage of coin that have been mined at the moment from the first time, so how many Bitcoin in percentage to the total that will be mined, a dummy variable which is which is 0 if we use the SHA-256 algorithm, which is the standard for Bitcoin. But as most of you that are much more expert than me in IT know that has some limitation. And 1 if we use the script algorithm, which is better. I don't know, I'm not an expert to say I read many coins that is better. And finally last variable, which is the number of calendar days from the beginning of altcoin. Why I propose this paper? In itself, it's a very simple regression. It's really sami prostая regress econometrica din. Why I want to propose it? Because I think it's very interesting, this idea, particularly given that many of you that work in this area. If you want to launch a new Bitcoin, a new altcoin, a new digital coin, because basically it tells you what are the main regressors that can influence on the price. And it's quite a nice idea. Of course, as a suggestion, I would say, also for a possible paper, probably an analysis that can be done, maybe in a panel, the regression could be even more interesting, because this is only cross-section in a single day. Would it maybe to extend this in a panel approach with more days? Probably the result would be much stronger. So, because really these are the main variables that may influence on the price. So computational power, number of altcoins found per minute, percentage of coins that have been mined so far. Remember, Bitcoin, for example, has been, we have 15 millions, more or less, Bitcoin out of 21 millions. And the same for all the others. Computational algorithm, SHA-250 or script, number of days from the birth of my digital currency. What did he found? I think he found some interesting result. Some expected, some not. Basically found that the higher computational power, the higher the price. This is not so. The more computational power, the higher is the price. This is an expected result. Why? Because if we have much more computational power employed for that digital currency, this means that there is a lot of interest for that currency. Okay, you know, a lot of investment, power, computational investment. So and this means that, of course, the price will go up. If instead very few people are mining that digital currency, it means the interest is not that great. Also, this is probably, I think, the most interesting result in a perspective. You know, I'm thinking if I was one of you in the IT business, I want to launch a new digital coin. What he found that the higher number of coins per minute, the lower is the price. I repeat, the higher number of coin mined per minute, the lower is the price.
Если быстро передать.
So, why this is probably the most important result? I repeat it. The highest, so the more digital coin I found per minute, the lower is the price. In itself is expected because it's just think about the normal currency. The more I print the currency, the lower will be in future its value to potential inflation and so on. The meaning is the same. The more coins I produce per minute, the lower is the value. So of course this is important because really this is also why the difficulty is good, that the difficulty in Bitcoin is increasing, because if it was so easy, then the value of the coin would be also very low. Also, he found that if I'm using a script algorithm, so the crypto value, digital currency that have a script algorithm has a higher value compared to those that use a SHA-256 algorithm. Okay, so this is good. So again, if I'm one of you in the IT sector, I'm thinking of launching a new digital currency, better to use a better script, more robust to attack, like script for example, than a SHA. So again, can be, I told you, thought as a if you are to launch a new digital currency. Instead, basically, he found he was very surprised to find this result, that he found that the percentage of coins mined so far, for example, I told you Bitcoin are 15 millions out of 21, so it's, I don't know, 60-70%. The percentage of coin mined so far from the beginning is not significant. He tried different regression, but it's not significant. He was very surprised by this result, and he says that maybe this, the fact that we have a limit in the total number of coins is not important. Why? He said that for him is because almost all altcoins can be divisible up to the 8th decimal place. He said, it's not a problem, even though if we have, I don't know, maximum of 10 million, 21 million, we just divide the coin. Most of them can be divided up to the 8th decimal place, so it's not a problem. This is why is his explanation. I'm not actually of that idea. My idea is actually because I'm more practical, I'm more cynical. I come from Intel, so I'm cynical by nature. It's because, my personal idea is why the total limit is not important, is that if you find the majority of miners that agree to increase that limit, goodbye 21 million limit. You just increase the limit to how many you want. Remember, all the walls are meant to be broken. So don't think that 21 million is in gold written and will be forever. No, forget about it. All the walls are meant to be broken in one way or another. So, and this is why in the paper said that the reason is that at a certain point I think the miners can meet, the biggest miners can meet, for example, our old Chinese, can really simply decide, we raise to 22 million and go goodbye. So this is why is my more cynical Italian explanation, let's say. Also, IS, and this is the last result that is interesting, found that the numbers of years from the birth of the digital currency is not significant. Here, the explanation they propose is that probably, and I think I agree with him, that is because almost all digital currencies are very, very young. In some cases, only months, at maximum 2 years. So, really, it's not a surprise that this variable is not. I think with more years, this variable will be considered, but at the moment, really, they're so young. There's no surprise that the years from the birth of the digital currency is not important at the moment. Okay. So this is a quite nice, simple, but it's quite nice that I really advise you if you are in the process of launching a new digital currency, or if you want to suggest how we can improve a digital currency. So because really we find out the main variable that influence the price in the digital world. Oh, finally, we arrive probably at the part of the night that probably if there are some Bitcoin traders here are more interested in. So econometric analysis with time series data. This is more interesting really for trading, Bitcoin trading. So also quite recent, quite young field of literature, but really a lot of interesting paper came out in the last 2-3 years. I propose you what I think it was the best. Almost all of them are published, so I only checked the peer-reviewed published paper. There are additional papers that a lot of them you can find online, but really I want to have some filter, a minimum filter. So all of them in this part are published because really in this section there are quite a lot with time series data. So let's start. So the first paper really that produced a time series analysis of Rémy Créador, was by CryptoEconomics in 2013. Actually, it's itself quite simple. Really, after 3 years, I think that is really too simple. But it was a start. Really, it was the beginning of a journey. Let's say, a beginning of a nice journey. So first, use two simple specifications. One, where basically use a vector autoregression. Всі знають, что это vector autoregression. Кто не знает, что это vector autoregression? Никто. Все знают. Vector autoregression is a multivariate model. Это многономерный модель, который вы можете использовать для анализа рядов. Это очень простой модель, где все зависимые переменные зависят от остальных раньше, в прошлом. Okay? So it's a linear multivariate model where all the variables, dependent variables in the first equation, the second equation, and so on, depends on the past of all the other variables. Okay?
I think I got it.
It's the linear mononomial model. So you see, so it's a bivariate vector regression where the log returns of Bitcoin prices depends on the log return of Google Trends data. Google Trend data. So it's the first major use in that field of Google Trend data. And he writes so because I told you Google Trend in most of papers is found to be significant. It's one of the main variables, and I met once a trader that told me that actually the Google Trends are used by trading, algorithmic trading in Bitcoin. This is an important variable. So as you see, this is a vector. Sorry, это маленький typo, это не -1, это без -1, маленький ошибка. So this vector depends on a vector of constant and the vector of log return вчера, недельный назад, 2 недели назад, 2 недели назад, 5 недель назад и так далее. Okay? So classical bivariate, very simple bivariate. And another vector approach, in this case a vector error correction, so co-integrated approach, where the daily Bitcoin, so daily, sta original daily, depends on the number of Wikipedia search. Couple of comments about this. Okay, yesterday I discussed about Google Trend, but of course another important variable, and which is also available for free, is how many times per day people are looking at the Wikipedia page. Of course, in this case, is the number of people looking at the Wikipedia of Bitcoin. These are for free, no limits, no standardization, everything available. If you are lazy and you're not really an IT programmer, so you have to connect with the API, so you want something like nažimat knopočku i получить CSV file, there is a nice website which is called Wikipedia Trends, которые дают такую возможность. Конечно, если вы IT-программер, вам нравится, вы любите работать с API, окей, пойдете в Википедия, сделать все, но, к сожалению, у меня время для этого нет. Я хочу сделать чуть-чуть по-быстрому. So Wikipedia Trend will give you the time series in CSV format of the number of searches per day from the first time when the page was created. Okay? I think if I tell you the truth, I think the Wikipedia is a good, was good, particularly many years ago. I think the value of this variable is decreasing over time. I think clearly it's important, but really, Wikipedia is more for really real beginners. So if, like I was myself 1 year ago, so the first place to start is Wikipedia. And then you go there, but then you go to more specialized resources. So it can be useful to understand probably, Google Trends and to a lower degree Wikipedia are good proxy of demand, of people demand. Let's say are good proxy of non-specialized demand, let's say, okay? Because really, I think, while a specialized person like Sergey or all other people may still use Google for search about Bitcoin or other altcoin, sometimes can use Google, but I think he used more specialized pages and so on. Wikipedia, I don't think that the person like Sergey goes, maybe from time, but I don't think he goes to Wikipedia to look for Bitcoin or digital currency. He uses much more specialized outlets, okay? So Wikipedia can be useful really, I told you, to measure a proxy of really unspecialized demand. In Italy, we have a very famous joke to represent this unspecialized demand, which is the lady with the bags of orange juice. Девушка с сумки апельсинами, okay? Которая, потому что была очень известная шутка, к сожалению, это была правда. Вы знаете, во время dot-com bubble, пузырь.com, вы знаете, 2000, когда все dot-com была такой газой, потом упал, была очень известный анекдот. Была эта девушка с сумками апельсинами, которая пошел в банк. Я хочу купить, не знаю, сейчас имя, это была известная компания в NASDAQ. Потому что эти акции не будут. Я хочу купить со сумки апельсина. Быстро, потому что эти акции они будут продавать и не будут еще. А после 3 месяца эта компания пошла в банкротство. И, конечно, эта девушка потеряла все, не знаю сколько количество евро, но не маленькое количество евро. Поэтому в Италии такая символ, so unspecialized demand with no knowledge of the lady with the bag of orange juices. So the Wikipedia can represent this, proxy this unspecialized demand. And as really, if you study all the theory of bubbles, of panics and crashes, this kind of specialized, unspecialized demand come really in the last phase of a bubble. Okay, in the last phase of the bubble. So it can be really checked if you fear that really we are in the last phase of a financial bubble. So they have to be controlled. Also, Christopher employed the so-called trivariate vector regression, where we have the Bitcoin log prices against other two variables. One variable is simply the price, time and dummy variable if the price is higher than the last n observation, and another which pick up, let's say, which is the price time and dummy variable, which is one if the price is lower than last n observation. So what are these this kind of type of dummy variables with positive or negative price? So Qt plus want to measure like positive pressure in the price. Qt minus want to measure instead negative pressure in the prices. And you use basically these two with the prices in a vector arrow collection in a co-integrated model. Okay, so a couple of comments about prices. Basically, no surprise, I found that the Google Trend Data, the Wikipedia searches have a strong positive effect on the price. So more people are looking Google Trends, higher will go the price. Okay, and also you're using the last specification with the positive trend and negative trend. It basically find out that if there is higher searches and negative trend, the price will go down further and similar. So really, it really is the first empirical evidence that Bitcoin price are really extremely sensitive to kind of speculative motion, because really, if higher search means higher price, this really can really create a simple a bubble. So, of course, the approach is very limited, and we'll see more. But really, is the first evidence of a potential speculative component in the Bitcoin dynamics. The first analysis, I think, is the most complete in some sense. Because the previous analysis is really too roughly. You cannot make a model with only two variables, Bitcoin prices and Google Trend Data. Really, you are missing a lot of variables. Is the one by Garcia, again published in that work, published in the Royal Society. I don't remember, it's a IT journal of the Royal Society company. So what kind of variable are you using in order to model the Bitcoin dynamics every day? Number of new Bitcoin users. So it's basically, and this is proxied by the number of daily download of the Bitcoin clients. Okay, so this represents the new users. So if this increase, probably this most likely will increase the price because more people will use it. If instead the number of users decrease, probably less people use it, so the price will probably decrease. Bitcoin prices, you consider the three possible alternatives in dollars, in euro, or in Chinese yuan. Information search, represented by Google search data, and as a potential robustness check also by Wikipedia, but this is only a robustness check, better Google, I agree with him. Another very interesting, unfortunately this is, it was lucky because he get this variable when it was for free, now it is not, is the number of, daily number of Bitcoin related tweets, okay, downloaded from Topsy, that now has been acquired by Twitter. Basically the number of tweets which include at least or BTC or hashtag BTC or hashtag Bitcoin or simply Bitcoin per day. Standardized with respect with the total number of tweets. Okay. This is a very beautiful, in some sense I think honestly, probably if you do intraday trading, algorithm trading, probably this is even more important than Google Trends. Because really, I've in Twitter, I have an account and I've followed a couple of Bitcoin accounts just to understand what's going on. Because unfortunately, in some account of Bitcoin, there are a lot of trash about related of advertising that I'm not interested in. And really, for their very few accounts in Twitter, really, I saw a lot of comments in trading. So I think really this is a very good proxy that you have to consider potential. Unfortunately, and this is the bad side, это грустный, очень грустный, сейчас это не бесплатно. Вы должны покупать это. So, если вы большой банк, окей, без проблем. Если идея Fantazzini, это не такое хорошее вещь. Okay. also, as an alternative, very interesting approach. He had done this on a robustness check. The previous model is the main model. Instead, in place of Twitter and Google Trends, instead of Twitter, to understand so-called social pressure, use the number of reshares of messages. I say, unfortunately, one day I hope someone will teach me how to do it. He found an API. Also, this is free. If you have, basically, you can download. If you have a good API, unfortunately, I'm not such an expert. You can compute the number of reshare of a message about Bitcoin in the Facebook page. This is quite interesting. It's a good proxy, and it's free. It's only a matter of, Garcia is an IT professor at ETH in Zurich, so he has the expertise to do that. For him, it's quite easy. I hope one day to learn how to do it, because this is quite interesting. It's for free, different from Twitter, but really you have to write some code really to download to compute a number of ratios. It's not that immediate, so you need an IT programmer to do that. But it's free, so this is the good news. So if you have some good programming, you can do for free. Okay, use data from January 2009, from the very beginning up to October 2013. Basically, he found out, he used a var1 model for varied with different modification. Remember, different robustness check, but the main structure, the baseline case is var1. And he found basically two cycles out of this. This is called social cycle and user adoption cycle. So basically this higher search volume, higher users, higher price, and also another, this is for Google and Wikipedia, another which is for social media, which is higher social media, higher number of users, and number of higher prices. So just to repeat, basically, so if we have more popular Bitcoin, this is of course the more Bitcoin become popular, the more we have volume, or search volume in Google or Wikipedia. Also, the higher social media, and then of course stimulates higher prices, and so due to the higher number of purchases. The second cycle study shows that basically we have a higher number of users download after the search of online information. Okay, and this of course again drive up the prices. Found this interesting result. Basically, he found out that in 3 of the 4 largest daily price fall of Bitcoin, Bitcoin has a very huge volatility, in particular, very easily can crash. He found that in 3 out of the 4 larger daily price, in the day before, there was a huge Google search volume. Okay. This really, its main comments that if you notice a very abnormal search volume compared to the average trend, this can be an harbinger, of a fall, a market crash. So this is why he advised basically to check not only the Google Trends, but the difference between the Google Trends and the average trend, the average search in Google Trends. If you notice an abnormal volume, be prepared because you can have some market crash. Remember, Bitcoin is very, very easy to have huge crash based on some, not only for some big crash like MTGOX, or for Ethereum, like
this is because non-qualified investors trying to enter the market. Girl with oranges, right? Loch in Russian.
Well, actually, take it.
Loch не мамонт не вымрет.
Yeah, even though.
Индекс бабушки, что не надо.
Imagine about this. I wanted to discuss a little bit because at the moment, actually, in Bitcoin, okay, in China. We are really the woman with oranges. In China, we are really a lot of women with oranges, housekeepers that go buying Bitcoin. But in Europe and US, we are not at that level because Bitcoin is too. Probably because it requires some minimal knowledge in IT, and also I told you in Europe and US is not yet available to the mass public. Because, for example, I know there is discussion at the moment. I ask Sergey for confirmation, and also for you. There is not yet an ETF on Bitcoin.
This is market for technological geeks.
ETF.
There was one
In Europe.
launch, I mean, this month only.
It was?
One contract launch in Gibraltar Stock Exchange for like ETF on Bitcoin. Another one was in Switzerland also 1 month ago. So it's just recent.
And
Just recent. It's not,
and
yeah, because I don't hear.
Winklevoss are going to launch ETF in US.
Yeah, probably. I think in the future, really, we will see
Yeah.
also in Europe and US.
If they will get the permission, then Bitcoin to the moon.
Yeah, because I follow also, for example, in Italy, in Germany, there are also classical financial blogs that are also, and they're not yet so much probably advertised such a thing. Instead, in China, really, there was a huge, and this created, of course, this large fall, particularly when there was a crash last year. There was really people really selling desperately in order to monetize the loss, not the gain. So, and this is really a very big problem because we have huge swings, and so luckily, given that it's unspecialized, most of them buyers, Google or Wikipedia, but particularly Google, can give us some warning sign. So if you say an extreme abnormal search volume, then this. In fact, I'm starting to follow in the last 6 months, thanks to this work, thanks to I start to follow Google and Wikipedia and all the other trends. And really, when you see that Google trend slowly increase, then you see that also the price increase. When you see the peaks, you have usually some fall afterward. And so I noted the same effect that Garcia found more precisely before. So if you see the small increase in search value, everything is good. If you see big increases, then something is bad is going to happen. Okay. I go on because really it's quite. I want to do some example. Maybe I'll come later. Garcia Schweitzer did even more. So this is the paper. So some of you yesterday asked me about. I want to do some algorithmic trading with Bitcoin. This is the paper that you have to go. Garcia Schweitzer, in another very nice paper in another multidisciplinary journal of the Royal Society, published this paper that is the first published paper devoted to backtesting an algorithm strategy and comparing with several other strategies. So it's the first work and the only one published, I mean, in the internet you find many, but really the only one published in a very, very good journal with a good filter. I never find a single published paper with the algorithmic trading and backtesting of profit and losses. So they use again a VAR1 model because they found that more sophisticated models tend to be less robust. This is why they use a simpler VAR1 and not more sophisticated models. Okay, they use the closing Bitcoin prices at 26.59 Greenwich time from CoinDesk, the daily volume of BTC, exchange in all the markets, the daily amount of blockchain transaction, the amount of downloads from the most popular Bitcoin clients, the normalized daily Google trends, the daily amount of tweets from Bitcoin. Attention, and this is the two variable are the most difficult, and actually you need an expert in text mining, which is Schweitzer. Schweitzer is an expert in text mining. And I think this is not surprising because these two are the most important variable in Bitcoin prices. The average daily balance of Bitcoin tweets. The balance in text mining is a measure of if Twitter are show kind of pleasure mood or displeasure mood. Okay. So it's if you feel comfortable or you don't feel comfortable. Basically, what they do just to get I know a little bit of text mining, but not of course an expert like Schweitzer. Basically, they take all these tweets, extract all the words, and build the balance. There is a huge literature about that. In order to compute the balance, to see how much it is happy, pleasurable or not. There is a lot of technique that you do that. Of course, for this you need a good programmer, an expert in text mining. Garcia is an expert in IT expert, Schweitzer is an expert in text mining. So I told him what to do. So Garcia took the tweets, these millions of tweets, extracted the text and used the software, the experience of Schweitzer to provide the values. This one, polarization of Twitter data, is the geometric mean of positive and negative words. Okay, so how is the discussion polarized? Okay, so basically the valence and the polarization are the two aspects in the text mining that tell you how the users feel on average that day. Not surprisingly, Garcia and Schweitzer found that these two, together with the daily trading volume, are the only significant variable, and the most important when you do forecasting in trading. Only problem, you need an expert in you need a programmer for taking all this Twitter and an expert in text mining to actually now there are many software. I know some basic thing, I do a little bit, but now there are also specialized software that extract all these millions and millions of tweets and compute the valence and the polarization, which are the two dimensions of language, let's say, that tell you if it is positive, negative, with discomfort or not. Basically, this is what I told you. I found that valence, polarization, and trading volume are the only one that have significant effect on Bitcoin. And using these three, so a model with one model with these three, give you profits also considering the transaction cost. Also consider transaction cost. And give you much higher profit than the classical buy and hold, momentum strategies, or other strategies. Okay? So this is to give you an idea. Okay, these are more, the paper that I present you now are, the previous paper are more, say, IT related, more IT expert, the people that want to do or day trade. And the next group of paper, published paper, all these published paper, really in very good journal, are instead, say, more economically based, are economists. You will see also because the variables are different. In fact, at the end of my paper, I said that I really hope that in the future, these two trends of the literature will unite, because really you will see there is quite a lot of difference in IT-related papers and economic-based papers. We have a paper by Glaser that actually not only consider attractiveness like Google Trends and Wikipedia, but also use supply and demand. And they use daily Bitcoin price, daily volume, Bitcoin network volume, daily views on Wikipedia, dummy variables for negative events, and so on. Basically, what he use, why you want to do this? The analysis of Glaser is a little bit different from the previous one, because you consider the exchange volume and the network volume. Because you want to understand, the question that the Glaser want to answer is, given all these variables, people, when they buy Bitcoin, they keep it in the exchanges only for speculation purposes, or instead they use Bitcoin to buy goods, to buy product, to do something else. Attention, exchange volume, network volume. So if people buy Bitcoin only for speculation purposes, it will stay only in the exchange volume, and all the other value will not be significant. If instead I buy Bitcoin because I think that is the money of the future, because I want to buy things and goods, then this will affect also the network volume. To summarize, because I'm a little bit late, actually find out that most of the Bitcoin stay in the exchange. Basically, the exchange volume is not influenced by the other variable. Which means, and the main conclusion of Glaser is that basically at the moment, the speculative issues, speculative motivation are the main one. So people stay in the exchange, don't use Bitcoin to buy goods and so on. I told you, this is in 2014. I think now things are changing. Okay, but at the moment, what the result that he found that the main driver is the speculative component. Okay, I want to finish. How much I left?
Actually, we can stop at any time.
Okay, so I finished this, then we do the break because already people are tired. Let's drink a coffee, tea, and whatever. Just to finish the last group, which is probably the most economist of all, because Bonjour, Selmy, and company are all economists. And they consider probably the widest group of variable, technical drivers, so Bitcoin supply and demand, attractiveness indicators, Google trends, and so on. Macroeconomic variables, which is the last group of variables. So what kind? I'll tell you some groups. So exchange trade ratio, so is the ratio between the exchange volume over the network volume, again to try to identify difference if there is speculative trading or not. Bitcoin monetary velocity. This is in the Bitcoin world is the monetary velocity is approximated by so-called Bitcoin days they destroyed. Okay, which is basically the number of Bitcoin in transaction, which is multiplied by the number of days since they were last spent. Is a proxy for monetary velocity. So number of Bitcoin multiplied by the days since they were last spent. I know that some of you from Central Bank may find this a little bit strange, but actually this is the main measure of monetary velocity for the Bitcoin world. So I repeat, Bitcoin days destroyed. Number of Bitcoins in transaction you multiply by the number of days since these coins were last used. It's quite good proxy actually. Another measure that unfortunately is no more available at the now, it was at the time when the paper, is this total output volume, which is another measure that tries to remove the exchange volume from the total trading volume. Basically, in order to only estimate the trading volume only due to transaction to buy goods, not for speculation purposes. Hash rates is probably one of the best measure of supply of Bitcoin. Okay, attractivity indicators is Google data, and then macroeconomic variables, the gold price and the Shanghai market index. Tell you briefly the result. So they do also here VAR model, vector, co-integrated model. So basically they build a co-integrated model with this variable. And actually they find that usually the most important variable are Google data or speculative component data, Bitcoin related data. So Bitcoin data usually are the main variable. I told you Google data also important, but to lower degree, while macroeconomic variable are of no importance. Macroeconomic variables are not significant. This is a result that is found in all the papers which include macroeconomic variable. In fact, one major comment made by a famous economist in the US, Yermak, is said that at the moment, Bitcoin is not correlated with the other macroeconomic variables. So cannot be used for diversification purposes because there is no correlation. In fact, all macroeconomic variables are not significant. In this paper or another specification, I'll go another one, also in the paper by Kanks, published also in Annals of Economic and Finance a couple of months ago, where again, the structure is the same. Bitcoin supply demand, number of Bitcoin, number of transaction, number of addresses, days destroyed for the monetary velocity of Bitcoin. Attractive indicators, Wikipedia, new members of Bitcoin, new posts. This is interesting. The paper by Kangs proposed a new measure of interest in Bitcoin, which is the number of new posts on Bitcoin Talk, which is quite interesting to measure the social interest. Again, also this is for free, but it requires a little bit of programming to download the number of posts per day. And macroeconomic variable, where you use the exchange rate, the US dollar against the euro, the oil price, the Dow Jones. Also in this case, they found basically the same result of the previous papers. So, main variable are Bitcoin supply and demand. Google data and Wikipedia also are important, but to some less degrees. Macroeconomic variable are no important, are no significant, which means again that for this diversification at the moment, Bitcoin seems not to be useful, because if there is no correlation at all with the other variable you understand from basic financial theory, then in this case cannot really be used for diversification. But these things may change. Anyway, these are the results, really very fresh, because the paper by Kang published on the Annals Economic and Finance really is published 3 months ago. Okay, couple of words. Yeah, this is what I just told you now. What the paper that I propose now are all paper published. I think is the best paper published. Published in Annals and Finance, Annals Economic Finance, or the paper by Garcia, published in these IT journals published by the Royal Society of London. So the top papers published. There is a website, Bitcoin Research, which report all publication, peer-reviewed and not peer-reviewed. So published in a journal, simply working paper without filter. If you are curious, you can go here, okay? But really, be careful about the quality of the paper. And here there are additional papers that you can find, but most of them are not peer-reviewed, are not published in journal. So the quality can be a little bit dangerous. So what I present here is the only published paper in good journal. So just to have a filter, minimum filter. Okay, so we do the break. Maybe later I'll show a little bit some example, at least how to do a VAR and so on, and then we'll move to financial bubbles and price discovery. So have a nice coffee, a nice tea. Okay.